I would say to you, we have not come anywhere near peaking. It could be a short-term peak. The banks just come in and buy it all, scoop it up on the cheap. It's called shaking the bushes. And it was done magnificently. You could argue that this was textbook. The speculators who come late, who think they're smart, who come in unleveraged, the big houses just shake the bushes real quick, and out comes all of the silver that they get to pick up.
The JP Morgans have flipped from being net short to net long.
But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month, big houses are saying, fine, I'll pay you, $1.50, $2 back a spot in order to take it off your hands. And that's how it went. I went everywhere and bought all I could.
Do you think, well, let me put it this way, has silver peaked? Did we see the blow off top? Maybe we're going to find some new baseline. Maybe it's 50, maybe it's 60, maybe it's 70. But we're not going to get into triple digits anytime soon. That is the question on people's minds right now. Do you have a strong opinion one way or the other?
I would say to you, we have not come anywhere near peaking. It could be a short-term peak. Look, we've had, within 2 weeks, we've had 2 big margin increases. Now, let's talk about what that is first and foremost. The margin increases, especially coming in thin holiday trading, which would amplify it more than anything, is designed, in my mind, to flush the weak hands out. What's more startling to me, and I'll come back to this in a second, is the amount of deliveries that we're seeing, which we're going to talk about. I had lunch the other day I don't think there's any problem with me saying this. I had lunch with the owner of the New York Mets the other day, Stevie Cohen, who's a big hedge fund guy. And I went to his house for lunch. He lives very close to me. And interesting man, phenomenally interesting man. We talked baseball the whole time. We talked baseball cards. My baseball cards. We talked baseball cards for an hour. We didn't really talk about economics. The reason I bring it up is he lives in the neighborhood. Mark Wahlberg is his neighbor. Alicia Keys down the street. These houses are $35 to $50 million. Do you think they care what the mortgage rates are? These people come in there and pay cash. Now, what I'm saying is that what the CME did is what they always do by raising margins on December 31st by 30%, and a few weeks earlier by 10 or 15%. It flushes out the weak hands who come in on margin, who wanted to capitalize on a silver market that's moving parabolic. Now, this is easy pickings for the big banks. Forget about the major trend. It has nothing to do with the trend. This is I'm going to scalp you because you think you're smarter than the market is and you're not big enough to play in this sandbox. So here's what we do. All of you who went on margin to buy more silver at leveraged silver in order to make money, we're jacking up the fee, the margin that you have to have within your account. And so we're going to jack it up to a level by where it's going to put some severe pain on your pocketbook. And if you don't pay that margin, if you don't do that right away, why then you are going to have your position liquidated, which happened. And let me see how many. The first time they did it, the amount of, so we saw 13,430 contracts sold in 15 minutes. That was the first one on December 12th.
Wow.
The 26th, they followed up with the second increase. Sorry, I thought it was the December 26th, day after Christmas. And they rose the margin up to $25,000, a $3,000 increase. But you saw huge, in other words, you have to have $25,000 to own a contract in your margin account. And so what happened was all of these contracts got liquidated. Well, who do you think came in there and bought it all? Well, the banks just come in and buy it all, scoop it up on the cheap. It's called shaking the bushes. And it was done magnificently. You could argue that this was textbook. The speculators who come late, who think they're smart, who come in unleveraged, the big houses just shake the bushes real quick, and out comes all of the silver that they get to pick up on the cheap. I don't think it's the top at all. I look instead.
This is the classic shakeout. Andy is revealing how the big banks manipulate margin requirements to force retail investors to sell. They crash the price on purpose so they can scoop up your silver at a discount. If you want to stay ahead of these institutional games and protect your portfolio, make sure to like and subscribe right now.
At one of the biggest anomalies that anyone has ever seen, let's talk about Christmas. The total Comex delivery notices as of December 26th, or in fact, the end of December, 62,875,000 ounces, record high for December of all time. Now ask yourself, who's taking possession of 62,875,000 ounces? We can look at the January 5th delivery report, where Deutsche Bank, now there's a rumor out there that the European banks are in hot water. Mm-hmm. And I talked with you about this.
Just sorry to interject, but you've told us in previous appearances that you believe the U.S. banks, especially the JP Morgans, have flipped from being net short to net long, and the ones that are still sort of stuck long were the European banks. So this
well, that's what the Economic Times said. Now, that was an article, and it's interesting. One of your subscribers, one of your followers sent me an email, said, I can't find it. So he and I go back and forth, and if you put it into ChatGPT or one of the search engines, it says, yes, indeed, this article is real. This article was published. You go to the Economic Times site, it was pulled. It says this is no longer here, interestingly enough. But one of your subscribers and I had a nice conversation back and forth about this, and we validated that it was there, that what I read and what other people talked about was real, and then they pulled it. Anyways, Deutsche Bank on January 5th issued, in other words, they delivered 3.27 million ounces. And who are the buyers? JP Morgan and Citigroup. They are the largest derivatives holders on the market. Now, when I say JP Morgan has flipped, according to the Economic Times, that doesn't mean that they don't have short contracts. They do. It just means that they're net long and exposure to more long than short. Which is a big rarity. But the bottom line with all of this is that the deliveries coming by the most sophisticated, well-funded traders in the world who are not using leverage, that is more important than anything. Yes, you can talk about the fact that it has been classified a critical mineral. Huge. You can talk about the fact that the European Union did it at the end of 23. Huge. You can talk about the Chinese export restrictions. Huge. But when the most well-informed traders in the United States are standing for millions and millions and millions and millions and millions of ounces of silver every single month for going on 15 months now.
This is the data point that changes everything. For years, JP Morgan was the biggest short seller of paper silver. Now they are standing for delivery and hoarding physical metal. When the biggest manipulator in the market switches sides, you know the price is preparing for a historic move.
That tells me that we are nowhere near the top. But you have end of quarter, end of month, end of year, selling, balancing books, taking profits. There's something on Comex that is called Section 1256. Most people haven't heard of it. It basically says if you trade gold or silver futures on a registered exchange like Comex, that you, no matter how long you hold the trade, it could be a day, it could be a week, it could be minutes or hours. When you sell it, the IRS automatically treats 60% of the gain as long-term, 40% as short-term. And that's a very big deal for active traders, of course. And of course, at the end of the year, the IRS also assumes that all open futures positions are marked to market. So there's a lot of, they can sell it, book it, buy it right back, and it doesn't trigger the wash rule. 30-day wash rule is something in securities that says if you sell a security for a gain, you can't buy it or anything else like it, or a loss, more appropriately a loss. A very wealthy person sells a rental property for a big loss to offset a gain on Apple stock or something. You can't buy that or something similar back to it for 31 days. So in any case, all I'm simply saying is that there are a lot of things happening at the end of the year, whether it be shaking the bushes, huge deliveries, rules on Comex that kind of make traders clean the books and then come back in. And then, of course, we have some other things that we'll get into about silver that I think are going to make this month incredibly volatile. The rebalancing of portfolios, where silver has gone up so high, it's now a disproportionate share of portfolios has to be rebalanced. Same time, you got hedge funds, the January effect they call it, coming in with all this cash. What are we going to buy? How about the best performing asset of 2025? Now that just got hammered down because of rebalancing, because of all of these things. No, the deliveries expose the rhetoric that these players who are standing for possession of billions every month are not doing this for the hell of it, Adam. It's just beginning. But to think it will be easy is fooling yourself. It will not be easy.
Okay. And by will not be easy, I'm presuming you more mean volatility, which is there's going to be a lot of shaking of the bushes here, and you want to hold on as best you can through it.
Right. The physical holding means nothing. I mean, there's no reason to sell your physical, not even close. But the paper price, which has a lot of speculators involved playing against some of the biggest institutions in the world with unlimited checkbooks, they won't make it easy for those guys and gals to hang on. They're going to get shook, I think, extremely hard over the next couple of weeks into the end of January.
He is warning you. The volatility isn't an accident, it is a weapon. The institutions are trying to scare you out of your position right before the next leg up. They want your physical silver, and they will make the chart look ugly to get it. Holding through this turbulence is the only way to win.
Okay, couple of things. First off, Thomas Rediker here just reposted this stream. Again, folks, I keep forgetting to figure out how you can repost, but apparently you can. So if you're watching and you know how to repost this stream, please repost it like Thomas did. It just helps get more and more people watching this stream, especially while we're doing it live. Also, something else that we should have mentioned right off the bat, which I apologize for forgetting to do, is Andy, you have been very kind in offering to this audience the exclusive offer of being able to purchase junk silver from Miles Franklin for $1 under spot, great pricing, while supplies last. And just heard from you before we hopped on here that supplies have now been consumed of being able to get junk silver at that price. That said, you're still able to offer it at a very attractive price. And again, this is all being influenced by not just people taking advantage of the offer, but by the margin hikes that you just discussed. So what is the current offer for viewers here that would still like
to and I'm going to also explain how I was able to do that. Let me tell you real quick what it will be. Again, and it's very fluid. That's what I want people to understand, that it's very, very fluid. I can do it for your subscribers for $1.49 over the price of silver. It's nowhere near what it was. But it's still pretty darn good. In fact, you know what? Let's call it $1.35 for right now until I can change. Now, let me tell you why I was able to do that for a very long time. And I went around for the last several months buying everything I could find in pre-65 silver. We have a network of a lot of small and mid-sized coin shops around the country that will sell to us because they don't hedge their position, and we'll take it when someone comes in. But here's what's happened. So you have a network of traders around the country, or dealers, thousands of small dealers, coin shops, pawn shops, all that stuff. And they will take in pre-65 silver. And let's just say for a period of time, there was more selling in the public than buying. And I've talked a lot about how premiums were low, making it advantageous for people who were able to take advantage of these low premiums. And this has been going on for a while now. So the dealers who aren't sophisticated like the bigger companies, and I say that from a standpoint of business operations, not their intellect, but being able to hedge. So if I have 3 million ounces of silver in my warehouse, like I will quite often, I'll hedge it. I'll sell short 3 million on paper. So if silver, I have 3 million ounces and it drops by $10, I'm down $30 million. I'm screwed. But it goes up on exactly the same amount on what I sold short on Comex. It allows me to be market neutral. That is what Comex was designed for. Okay, so imagine you have all of these dealers who don't hedge and they don't have anyone buying it. So what do? Every week they will go to their local refiner and sell it to the refiner, who will melt it down into bars. And the refiners have been loaded up on bars and on candlesticks and on jewelry and on all sorts of stuff, plus demand to make bars and rounds, right? So even the decent size refiners, the big ones, they're getting loaded up on metal to make bars and rounds, even if they're taking in 1,000-ounce bars to do it, right? So let's say they have 50 million bucks in their warehouse. Now, when I use Comex, I'm selling through my inventory, bang, 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 and replenishing. So I'm constantly getting money to cover my positions and to do all the things that you need to do to make this work. A refiner, on the other hand, takes all this stuff in, has to melt it down, pull out the impurities, turn it into what's called shot. They're little BBs, ball bearing size things that they can then melt down and turn into bars and rounds. Now, this whole process, especially when they're continually getting stuff in, could take weeks, 4, 5, 6 weeks of various stages of production. And they're hedged. They have to hedge that silver that they took in, they paid for from the public. So they got millions and millions and millions of silver inside the various stages of production that they hedged. But what's happening? Silver has been moving up so fast, and they're not pulling this stuff out or making the refined product fast enough. They're getting margin called. And they're like, oh my gosh, silver's going up. Our short position's getting margin called, just like these traders are. Pony up the money or your position gets liquidated. So they stopped taking new silver orders or refining orders weeks ago. And so this silver, months ago, this silver just sat there, where now the big houses are saying, fine, I'll pay you, $1.50, $2 back a spot in order to take it off your hands. And that's how it went. I went everywhere and bought all I could.
Listen closely to this supply chain breakdown. While the paper price fluctuates, the physical supply chain is snapping. Refiners are jammed, dealers are liquidating, and the whales are quietly draining the real physical inventory below spot price. This disconnect is your opportunity.
And now you're starting to see it reverse again, because the demand always will catch up with these imbalances in supply.